What's behind this rally? Why is it so powerful? Is the street really behind in their numbers going into this next print?
So as we think coming out of 2019, the NASDAQ was up about 35% or so, right? But as we all know, you were coming off an artificial dip. And so if you go before the dip and maybe look from October 1st to the end of 19, that 35% is actually more like 15%, right? So strong year, don't get me wrong, but maybe not as anomalous as some would think. You can also look at it on a two-year stack basis. So if you go from the end of 17 to the end of 19, how have we done? Up about 30%, or a CAGR, compounded annual growth rate, of about 15%. So once again, strong, but not necessarily anomalous.
You mean in line with historical patterns?
Yeah, exactly right, exactly right. And then you also think about the impact to the averages on the NASDAQ from Apple, Facebook, Microsoft. So of that 35% growth, they're about 15 points of it, right? So if you pull them out, it'd be a 20% growth year. Once again, great, strong, but not necessarily anomalous. It reminds me a little bit of what Bill Miller used to say from Legg Mason, right? He beat the S&P 15 years in a row. And, you know, his line was, it's an accidental fault of the calendar. Like, only from January to December did he actually beat the S&P. So I think when you look more recently and just think about last year, it's not just January to December, but maybe accounting for that anomalous dip at the end of 18 to get a better feel for how the year was. Strong, but I don't think overly anomalous.
How great do earnings have to be the next time they come out for this to be maintained, though? Because, I mean, valuations are kind of stretched.
Yeah, it's a great thing. So the recent part of the rally has been driven by multiple expansion, right? So the S&P historically over the last 5 years trades around 16.8, give or take. Now we're over 18, right? If you look at high growth tech stocks, typical multiple on that revenues is about 7.5 times or so. Now we're at double digits. So to your point, multiples have expanded. Can earnings now expand along with that to get a further run, to get further growth? What I think was interesting was coming out of 3Q, if you recall, it wasn't a great earnings season, right? It wasn't a great rally. There was a lot of conservatism, not only in 4Q, but looking forward. So to Carl's point, we actually could be at a point now where maybe Wall Street has emphasized the conservative, and maybe there is some upside room to these numbers.
What does all of this mean for the M&A outlook this year?
So we're coming off, a $4 trillion year. It's the fourth best year in history. So a tremendous M&A year that we've had. And we think the M&A trends are going to continue now into 2020. And because of that, we think that's going to also help support valuations, right? Whether it be ultimately takeouts or just competition in the marketplace. So ultimately supporting the valuations from here. When we think about going into 2020 and what can drive these valuations, and there's a couple different things to think about. One's the macro, right? So low interest rates. You should be willing to pay a higher multiple for a high growth name, with doing that. Also trades and tariffs, right? That coming back down and being more reasonable, that helps support it. Regulatory can help support it. Earnings growth that you're hitting on can help support it. So there's a bunch of different things that can drive these trends into 2020 and beyond.
But what's cheap? What's cheap to buy in M&A?
It's a great question. and I think some of that's going to take a little bit on your view on time frame, too. Is it cheap off of this year? Or you think some of the PE players, it may look expensive at first, but they're going to have to go through a year or two turning something around, cost cutting, getting the company on the right track to come back out. So I think what's underperformed in 2019, the internet names were only up about 25%. Software was up about 30%. Semis, as you know, was up 50%. So a very strong year for semis. And when you think about caps, the large caps did very well. I already mentioned, Apple, Facebook, all that. So the SMIDs didn't necessarily, right? Sort of a mixed bag there. So there could be some value found there as well.
Are we going to see the impact of the collapse of the Softbank vision thesis?
Yeah.
Maybe even beyond just the startups that they're invested in?
Yeah. Great question. And I'll take it away from just Softbank and say what we're hearing happening from when we talk to VCs in the Valley. Yes, absolutely we think so. And we think what's happening, and we tell every one of our companies we talk to, meet with their boards, is that you need to be able to show a path to profitability or at least strong underlying unit economics. As you know, those questions have weighed on Uber, Lyft, obviously WeWork. There was questions around those things. And so every company now, from the C-suite to the board of directors, needs to have that path to profitability and those unit economics if you're not already profitable. And in 2020, we should see some of these IPOs come out that actually are profitable, right? So it'll be interesting to see that mix as well.
which is exactly my next question for you. What does that mean for the IPO pipeline this year?
Yeah, so the IPO pipeline, if you look at the 2019 class, right, the average return of all tech IPOs was somewhere in the mid-teens, 16, 17% or so. However, if you think about a portfolio manager building out their position, they can't buy their full position on the offer, right? So look at the price maybe over the first 30 days. And if you look at that, where the retail market is or where these portfolio managers would be, you're down about double digits or so from that point. So that sort of sets the backdrop of how the 2019 did. As we look towards 2020, though, you've got over 450 unicorns right now in the private markets, right? We think a lot of those are coming in 2020, and particularly when you see 2020 first half loaded. I think the second half's a little bit murky because of the elections.
Okay.
We don't know who the candidates will be now, but I think companies that are thinking about going in 2020, you want to go in that first half before you start getting to all the election questions.
You mentioned some of the names that issued last year, Uber, Lyft, Pins, Peloton, Smile Direct. None of them have recovered their IPO price.
Yeah.
How does that weigh on the calendar for those this year?
It's really interesting because when you bifurcate it and you split it out and you look at SaaS-type companies or companies with more predictive revenue, recurring nature revenue, that class in 2019 has actually done extremely well, up about 40% or so. Now, if you look at the exact opposite of that, the companies that don't have those, they haven't done as well, to your point. They're down about 20% or so. So I think you're going to see a greater emphasis from investors on the predictability of these revenues, the stability of these revenues, and once again, back to those unit economics. Do they have the strong unit economics?
I thought it was really interesting. Chase is altering the terms of its Sapphire Reserve card, which is all the rage, and the two big perks are Lyft and DoorDash subscriptions. Does that say anything about where the subscription economy and the revenue models for those kinds of companies might be headed in the next year or so?
It's a really good question. And obviously, investors love subscription companies, right? Because you can count on that predictive nature, particularly if you have a low amount of churn. But a lot of people have been looking for those models to evolve. How do you expand those subscriptions? How do you get, A, more lead of customers coming in, or B, being able to offer more such that you can keep increasing those prices of the subscriptions? So I think it's a really interesting point.
I just want to go back to, you're talking about the macro backdrop real quick. Given the fact that geopolitics, the geopolitical risks right now are still so front and center, does that make it more or less likely that some of these tech and software names get bought up this year? It has an impact for sure, and particularly one that I'll point to is CFIUS, right? So if you notice cross-border M&A, even though we just had a record year, we're in the top 4 ever, CFIUS is weighing on cross-border deals. So as far as M&A cross-border, it definitely weighs on that. But as far as valuations, I mean, even just take the recent conflict with Iran. I mean, we're up at all-time highs, even having gone through that. So I think investors are looking through some of this. And the interesting part is everybody has been expecting a recession, right? A recession that just hasn't come, right? So there's almost this cautious optimism as everyone looks towards 2020. Yeah.